All right, so thanks a lot for inviting me. Very happy to be here. So I'm presenting this paper on automated market making and loss versus rebalancing. And so this is joint with Jason Milionis, who's at Columbia CS, Siamak Molemi, who's at Columbia GSB, and Tim Rothgarden, who's at Columbia CS and A16Z Crypto. And so while I'm talking, feel free to interrupt me with questions, or I guess ask questions in the Q&A. So traditional question in finance economics is basically, suppose we want to arrange the exchange of assets, right? So suppose you want to exchange, say, Ethereum for US dollars. And then a traditional solution to this problem is to have a limit order book, right? So CME, Coinbase, Nasdaq, all of these run as limit order books. And then, so basically what a limit order book is that it's a continuous auction, right? And so what happens is at any point in time, there's a bunch of buy and sell orders where basically these people are willing to sell at these prices. These people are willing to buy at these prices. And then they say how much quantity they're willing to buy or sell, right? And then whenever you have a sell, which is at a price and a buy, then a trade occurs, right? So you match pairs of mutually acceptable orders. If we want to do this on a blockchain, there are a couple problems with this. So then it's kind of costly to store and compute limit order books on chain. You have to store a lot of data points to organize a limit order book. And then when prices move, you also have to update the limit order book a lot, right? And then so normally to run a limit order book, you also require pretty active participation of market makers to take these orders and sort of change them over time. And then so if you have long-tailed assets, this may or may not be possible. So there's a very clever solution that crypto has come up with, which is automated market makers, right? And so the key idea was introduced by a paper by Gutierrez, Koppelman, and Liu in 2016. And the idea is basically you have a bunch of liquidity providers, and liquidity providers supply whole pools of, say, pairs of assets, US dollars and Ethereum, right? And there's just a rule. The automated market maker has that it's willing to accept buy and sell orders at any given price. And so this has been used in prediction markets for a while. Their use in trading pairs is relatively new. And quoting is automated. So this is what saves the data space, right? And sort of the price is purely a function of how many of each asset. And then these are called constant function market makers. Why would anyone want to provide their assets in these systems? Because you earn trading fees, right? Of these are that you don't need to store that much data. You can do the computations pretty quickly, right? And then instead of active liquidity providers like Jump, most of the LPs here are relatively passive. Question we want to answer here looks at the decision to go in an AMM and provide liquidity on an AMM. And the question we want to ask is basically, when does liquidity provision in an AMM make economic sense? When is the benefit greater than the cost? A deeper question, which we're trying to clear up, is what exactly is the cost of being an LP in an automated market maker? So with those broad questions, here's what we kind of want to do in this paper. We're going to try and do something that's pretty ambitious, which we're going to try and build effectively a Black-Scholes formula for automated market makers. Black-Scholes for options can be thought of as doing two things. Black-Scholes for options qualitatively says, I have an option on a given stock, right? That thing, when is it worth more or less, right? And then Black-Scholes basically says a call option on a stock is worth more when the stock price is higher, when the stock is more volatile, interest rates, so on and so forth, right? And so the first thing we want to do is a qualitative contribution, right? We want to build a model that highlights the forces that drive AMM LPing returns. Volatility of the asset is going to affect LPing returns. Curvature, marginal liquidity, how aggressively the AMM trades when prices move a given amount is also going to affect AMM returns, and then trading volume is going to affect AMM returns. Effectively, this is a somewhat classic trade-off, somewhat known in the literature. We're going to formalize it. What an AMM does is that it gains money when it collects trading fees, and it loses money when prices move around. It suffers volatility losses. The more money it loses, the more aggressively it trades, the more it loses. We want to do more than just that, though. Besides having a qualitative model of these, Black-Scholes is also a quantitative model. Black-Scholes can be fitted to data to give like a pretty good measure of what an option is supposed to be worth if you put in a volatility input, stock prices, so on and so forth, right? So beyond just our qualitative contribution, we also want to quantitatively write a model that's realistic enough that we can bring it to data to actually measure returns on AMMs. So basically, this is what we're trying to do, a qualitative and quantitative model that you can actually fit to data and quantitatively say, is LPing for this AMM worth it? The core idea of what we do in the qualitative part of the paper is actually also philosophically quite related to Black-Scholes. Black-Scholes says we can think about an option by basically delta hedging that option, right? We're going to do exactly this. Suppose that you're making markets by providing Ethereum and on a LP position, right? What we're going to do is delta hedge that, short the same amount of Ethereum that your US dollar ETH LP position holds at any point in time. And then what we're going to show is basically once you delta hedge, you kill market risk. You're no longer exposed to price movements of Ethereum. What you're left with is that the delta hedge liquidity provision, the LP position P&L, is equal to trading fees you collect minus a term that we call loss versus rebalancing, or lever, right? So then the question becomes, I understand fees, what is lever? Lever is a term that arises from, as I'm going to tell you, the design of AMMs, while very elegant in the sense that they don't have to respond to market conditions, the core design flaw of AMMs is that by design, they always trade at worse than market prices. So when there's a gap between the AMM price and Binance price, the AMMs is going to trade at a price worse than Binance. What that means is that profits are going to be left to the arbitrageurs who trade against the AMM against Binance and extract that profit, right? How much does the AMM lose in basically this process where it only learns prices, but it always does trades with slippage? The intuition here is basically that lever at any moment in time, loss versus rebalancing, is going to be proportional to how much prices move around. Every time prices move around, you get sniped and you lose money. And then this term that we call marginal liquidity, which is how aggressively the AMM trades when prices move a given amount, right? So the intuition here is pretty simple. I'm going to go over in detail how we get here. When prices move around, you lose money because you get sniped. The more you trade when you move a given amount, the more money you lose from slippage. So this, we think, is a nice way to connect kind of AMM literature to a bunch of stuff that we in economics are somewhat more familiar with, right? So it's reminiscent, as I'll talk about, to basically the high frequency trading literature, where there's mechanical sniping from basically prices moving around and sort of arbitrageurs not being able to update quotes in time. And I'm going to draw an analogy to that literature. The qualitative model helps us because basically once we isolate that basically AMMs suffer a slippage cost, that gives us some insight on how AMMs could be redesigned to reduce or eliminate lever, right? So basically, if we designed an AMM that did not suffer this slippage cost, if we designed an AMM that watched Binance prices, for example, and then basically updated prices so that it did not trade at worse than market prices, in principle, you could eliminate or reduce lever. And we'll talk about the feasibility of this later. The other nice thing, qualitatively, is that like Black-Scholes, our decomposition is not simply conceptual, right? We're basically saying, okay, let's think about delta hedging LP returns. Well, you can do that, right? You can go ahead and just go in the data and basically short as much Ethereum as your AMM holds at any point in time. So this, more than being a conceptual object, is something that you can actually trade and do a fairly simple trade and attain the delta hedged LP P&L in the data. That's pretty much what we're going to do next, which is we're going to, in the quantitative part of the paper, go in the data and then measure what the returns are for LPing in the Uniswap V2 ETH-USDC pair. If you totally ignored the fact that there was a cost, right, to LPing, you would basically say, okay, so the pool is worth $125 million. The pool is collecting $66,000 in fees daily. So it looks like we get a pretty good return of like 19% annually, right? And the problem is, of course, there's a cost, right? And then our formulas give us a very simple formula for the cost of AMMing. It turns out for the constant product AMM, if you calculate our lever formula, you get an extremely simple formula for how much you're losing every day to the slippage to arbitrageurs sniping you against Binance. The 24-hour lever cost, the cost over any period of time, is simply equal to the volatility squared divided by 8. So literally, this is how much you lose. I can quantify how much arbitrageurs are gaining by ripping me off against Binance. I can quantify how much I'm losing relative to the benchmark where I kept all those arbitrager profits. And it's literally the square of the volatility divided by 8. And then what is that? That turns out to around 3 basis points a day. So 3 basis points per day, right? And this is like quite a lot annualized, like 10% annualized, right? So every day I'm losing 39K to arbitrageurs ripping me off. And so a lot of the money is leaking out, right? So for my 66K in fees, I am leaking 39K of it to arbitrageurs. And that gives me a still moderately high return of 8%, but basically a lower return than if I only got fees and didn't suffer any costs. So that's the sense in which our model is quantitative, right? It has not henceforth been possible to basically, to our knowledge, go in and say, here's what prices do, how much are you losing, right? And then sort of we give this conceptual argument about how, like, if you delta hedge an AMM, the amount you're losing is precisely sigma squared over 8. And then you can take sigma squared over 8, measure in the data, and then this is how much you're losing. I'll show you a more sophisticated version of this exercise later on in the talk. So we think we fit into a couple of literatures, right? We fit into the option pricing literature and market microstructure literature. We fit into the literature on AMMs and prediction markets, and then we fit into the literature on AMMs for the recent literature on AMMs. So moving forwards, there are no questions. Let me talk about our model. Essentially, we're working in a Black-Scholes setup. So continuous time Black-Scholes. So without loss of generality, there are two assets. So then there's a risky asset, which we're going to think of usually as Ethereum. There is a numeraire, which we're going to think of usually as US dollars, right? And then without loss of generality, we assume the risk-free rate is 0. An important assumption we're going to make is the risky asset we're going to assume is traded on an infinitely deep centralized exchange. So what that means is basically that I can trade an infinite, I don't move prices. The AMM suffers price impact. Once you trade enough, the price moves. The Binance price does not suffer price impact. Is this a reasonable assumption? At this point in time, it's not bad. So at this point in time, if you sum up all DEX market shares, right? Ethereum DEXs have a market share of trade volume of Ethereum in the ballpark of 10%. And then so if you add up basically Binance, Coinbase, and now gone FTX, you get basically trade volume, which is roughly 10 times bigger than the Uniswap volume, than the DEX volume, right? And so basically, it's not a terrible assumption for liquid pairs right now that DEXs still have the minority of liquidity. Depth is greater on centralized exchanges than decentralized exchanges. So it's an assumption, but basically, it's not a terrible assumption in the data.
Can I ask a question?
Yeah.
But it's also an assumption that the liquidity providers in the centralized exchange platform, let's say, are not so in the way they provide the liquidity. Because, like, if someone wants to do a very big transaction on Binance, I guess that the liquidity available not going to be infinity indeed, in some sense.
Yeah, so we're assuming it's infinity. Yeah, that's a
yeah. But I'm just asking, like, if you know a little bit about how much indeed liquidity there is in SEC, and not just volume.
I think that sort of price impact on Binance versus Uniswap, the answer to that question depends on who you ask. I know there's a Uniswap post that argues it's like around the same. If you assume it's proportional to volume, then my argument that Binance is deeper would go through. I'm not aware of a clean way to measure it. I think because of the fact that it's hard to measure price impact using just bid-ask spreads or stuff like that, right? So I'm aware of a number of studies looking at this from the perspective of sort of quoted book depth and finding similar results. If you believe that sort of actual market depth is a bit deeper than quoted book depth, then you might think that sort of you have deeper finance markets. So I have not, we have not done this exercise here. I think that for the purposes of our model, this motivates that perhaps it's not unreasonable that Binance is deeper, but it boils down to the answers to that. Another thing I'll say is basically, like, it's also true in options that basically Black-Scholes assumes infinitely deep trading in the stock and no price impact, right? So you have the same issue there. And sort of what happens if this is not true? Well, sort of it's a conceptual model for thinking about if you can infinitely deep trade this stock, what happens? So another way to think of our model is sort of as a kind of conceptual benchmark, even if it's not literally true. Yeah. But point definitely taken that it's not entirely clear. Price impact is kind of what we want. That's not entirely clear. Yeah. Thanks. Okay, so then what we have is that the market price of the asset, the geometric Brownian motion, right? So basically what happens is that at any finite increment of time, the price evolves in a way that's basically normally distributed. Like increments are basically normally distributed with some variance, right? And then so the instantaneous return is the product of some return volatility times the Brownian increment term. And then we're working directly in risk neutral measure. And then so we assume basically that the geometric Brownian motion with no drift term. Okay, so I assume this audience roughly knows what constant function market makers are. So a constant function market maker is described by a bonding function, f. And the bonding function basically says there's a curve. The level curves of the bonding function are, for example, f of xy is equal to L, right? And then so, for example, in the constant product market maker, we have xy equals xy. And then suppose that basically LPs contribute reserves such that f of x0, y0 is equal to L. We're going to allow any trades that stay on this line. So for example, if we start here, we can go basically to this point, or we can go to any point on this curve. And then so this would be the price of this trade. And then clearly this secant line is the price because of the fact that basically sort of if I go from x0, y0 to x1, y1, the price of x1 in terms of y1 is the slope of this line. And so the slope changes depending on how much x you purchase. There's a notion of basically the instantaneous price, spot price, implied by an AMM, which is basically the tangent line, right? And then the idea is at any point, if the Binance price is equal to P, then we're going to get to the point on the AMM where the slope is equal to negative P. The market maker collects fees proportional to the quantity traded. And for example, UniV2 collects a 30 basis point fee on contributed assets. And then the final thing is that how do we move level sets over time? As LPs mint and burn shares, you can deposit stuff in this AMM and then that moves it up. If you withdraw liquidity from AMM, we move down. So those are the basic rules that describe how AMMs work. Okay, so the final thing I have to discuss in our model is to describe who are the market participants in this system, right? So we're going to adopt a stylized model with two kinds of traders. The first is arbitragers. So arbitragers can trade on the CFMM, or they can trade frictionlessly on the infinite depth centralized exchange. And then so the role of arbitragers is very simple. They're going to arb the CFMM until the prices are exactly equal to the centralized exchange price. We're going to assume for the arbs do not pay trading fees. That's important because basically then we can make it so that the AMM always has the same price as the centralized exchange. The second type of traders are noise traders. They might have idiosyncratic reasons that they only trade on this constant function market maker. They do pay trading fees, and the cumulative fees they pay at any point in time is phi t, is how much we've collected from noise traders. So my noise traders here serve one role, and that is to pump money in the system through trading fees. And so that's basically what they do. Now I'm going to jump into the analysis. So an object I'm going to define is the pool value function v. Now the pool value function v is the monetary value of the CFMM holdings at any point in time. What is the monetary value? Suppose that at a point in time I'm here and the slope is negative p, right? If I just sell all my Ethereum for US dollars and walk away, what do I get? I just get p times x plus y, right? And then so this is basically the mark-to-market value of everything the CFMM holds at any point in time. Now, what is v? V is the minimization over x and y of the monetary value of the pool. So what is this doing? This is basically saying at any price p, right? If the price is equal to this and I'm over here, right? Then basically v says, let's find the point which minimizes value according to this price, and then sort of evaluate the value of the portfolio at this price. So this may be familiar if you think about, this is the expenditure minimization problem of the consumer, right? So how do I minimize the expenditure at price P while staying on, you can think of it as the consumer's utility indifference curve, right? Why is V a useful object? V is a useful object because when the price is P, And then we are on this level set of the AMM, right? Arbitrageurs are going to trade while staying on this level set and maximize their profits. If they maximize their profits, they're going to minimize the AMM's value. And so basically, V is a convenient way to say basically at any price P, we're guaranteed that the arbitrageurs are going to move to this point, right? And then so the arbitrageurs are going to make it so that the holdings of the AMM are worth this point. So basically, V of P is, due to that argument, the value of the AMM's holdings at the price P. Given that, V is useful because how much does the AMM make at any point in time up to time T, right? The profit and loss of the AMM at time T can be written simply as follows, right? I put some money in the AMM at the start. That money is worth V0. At the end, I'm going to take all my Ethereum and sell it out and then get it to US dollars, right? And that is worth VT. Wherever I am at time T, I sell for VT. And then I collect fees at any point in time, right? So the profit and loss of the LP can be written as mark-to-market value at time T, mark-to-market value at time 0, add fees, right? So minor technical assumption, we need to assume exists a solution to the expenditure minimization problem. We need to assume differentiability of V. Those are pretty easy to satisfy technical conditions. The key idea of what we're going to do is that, take this, right? This is pretty easy to understand. How do we understand this? How we're going to understand this is we're going to decompose the change in pool value from time T to time 0 using the idea of a rebalancing strategy. This is the delta hedge I discussed. So how do you delta hedge a CFMM? If you're familiar with options, it's pretty similar to how you delta hedge an option. At any point in time, the CFMM, given a price, holds a certain amount of Ethereum. What I'm going to do is I'm going to adopt a trading strategy that does exactly that. I hold exactly the same amount of Ethereum as the constant function market maker. But instead of doing that through the market maker, I just make exactly those trades at the Binance prices, right? And then so formally, what we're doing is that we're going to derive a self-financing trading strategy, a stochastic process, which has initial holdings, which are the same as my AMM pool. So X0, Y0 is the same as what the AMM holds at time 0. Then what I'm going to do is I'm literally going to track what the AMM does at any point in time. So if the AMM prices move up and then the AMM sells some Ethereum, then I, in my rebalancing strategy, I'm going to sell some Ethereum. If prices move down, I'm going to buy some Ethereum, right? So let's call RT the value of this rebalancing portfolio that does all the AMM trades, but does it at the Binance prices, right? How can we figure out what the value of the rebalancing strategy is? Well, it turns out there's a very simple formula for this, which is basically the rebalancing strategy starts at V0, the same value as the AMM, right? And then the rebalancing strategy trades at market prices. And if it trades at market prices, then basically at any instant of time, the change in the rebalancing strategy's return is the amount of Ethereum it holds times the change in Ethereum price. So this is the envelope formula, right? If you hold like 10 apples and the price of apples increases by 1 cent each, then you gain 10 cents. And then we can calculate the rebalancing portfolio's value at time T. RT is equal to the value at time 0 plus the integrated form of the envelope formula, right? Now we're going to define loss versus rebalancing as the following way. The idea is to delta hedge the AMM pool, right? So then we can ask the question, how does the pool's value evolve compared to this strategy, which does the same trades, but does them at Binance prices? So how much does VT lose compares to making the same trades at the good prices? And then the core theorem of our paper, in a sense, which I showed you, which is that loss versus rebalancing is the integral of a process. The instantaneous loss versus rebalancing, script L, depends on variance, and it depends on marginal liquidity. And then so this is a pure loss term. At any instant of time, the AMM always loses money. It loses money in a way which is this always increases, and we can perfectly predict in every instant how much money it's going to lose if we see marginal liquidity and variance. So if there's one thing I want you to remember from the paper, it is this picture, right? And this picture explains what is loss versus rebalancing, where it comes from, and also where the formula comes from, right? I've mentioned a bunch of times that basically the loss that AMMs suffer is a slippage loss. And then so sort of, it's a lot of fun presenting to economists because economists can actually follow this. It's harder to get computer scientists to follow this. Suppose we start at point A. The familiar picture we see is basically that at point A, when the price is red P, right? Then basically we're here. And then suppose that we change the price to P minus DP. So we're here, right? Then if the price is this line, we find the new tangency line, which is B, right? So we know that the AMM trades from A to B when prices move from P to P minus DP, right? So I've told you about the rebalancing strategy. How do we think of the rebalancing strategy on this plot? The AMM buys DX when prices move from P to P minus DP, right? So we go from A to B. We're going to do the following thought experiment. Suppose the prices move from P to P minus DP. We wanted to buy DX, but we wanted to do it in the most efficient way possible. Well, what we could do is we start at A, prices move to P minus DP here, and then we now have this budget set, right? And then if we want to buy DX, we can achieve any point on this line. So we can buy DX by going here instead. If you trade at the Binance price and prices move from P to P minus DP, you go here to B star. B star is strictly better than B, right? B star is strictly better than B because we bought the same amount of Ethereum and then we end up having more US dollars, right? And so basically what I mean when I say the AMM structurally by design loses money is that the AMM's rule basically says when prices are P minus DP, offer a price which is this, which is better than P minus DP, right? What does the arbitrager do? The arbitrager says, well, I'm going to buy DX from you and go from here to here. I'm going to turn around and sell it to Binance, go from here to here, and I'm going to make this vertical bar, right? The AMM could be designed to eliminate this loss by basically sort of saying if we could somehow tell the AMM, trade at this price, don't trade at this price, we could eliminate this loss, right? But this argument illustrates why it is that AMM suffers slippage loss, because when prices move, instead of trading at the new P minus DP price and going to B star, the AMM trades at a kind of average between the old price and the new price. It trades at this line. It loses money, and an arbitrager who buys at this price and sells at this price makes money. And the quantity, the amount of money that is made is the height of this vertical bar. So I'm going to pause there if there's any questions, because this is really like the core of the paper. Yeah, so I'll take any questions about this. Yeah, so we need to go over it one more time. The AMM, whenever prices, oh yeah.
Can you maybe say something, or maybe you want to do it later, about comparing this to the impermanent loss? Because most of the people know impermanent loss, and maybe it's important to say what is the difference.
So
the traditional impermanent loss.
We have a picture somewhere about why impermanent loss in a sense is a wrong concept. I think I'm not sure if it's in the current version of the paper. The impermanent loss concept says the following, right? When prices move from A to B and back to A, then the AMM doesn't lose any money, right? And then basically, that's why they say the loss is impermanent. Well, the key why that's the wrong concept is actually that's the wrong benchmark. Why is that the wrong benchmark? Suppose that you adopt the rebalancing strategy, right? And then so basically in the impermanent loss example, right, when prices move from P to P minus DP, you move from here to here. And then when prices move back to A, you move from here to here. What does the rebalancing strategy do? The rebalancing strategy, prices move from P to P minus DP. Then I move from A to B star. Prices then move from P minus DP back to P, so the price looks like this. I'm going to move over here. If I do the rebalancing strategy, which is a totally viable trading strategy, if prices move down and back up, I make money. I don't just go back to where I started. I end up better than where I started. So that looks like magic. How did I devise this trading strategy that literally makes money for free? The reason it makes money for free is because this is a trading strategy that bets on convergence. If I adopt a trading strategy that sells when prices goes down and then buys when prices go up, I make money in the case that prices revert, but I lose even more money in the case when prices diverge. This trading strategy breaks even in expectation if prices are a margin yield, right? The AMM trading strategy, if prices move and diverge, loses money, and if prices move and go back, breaks even. AMM trading strategy loses money for certain, right? So this is the core hack of impermanent loss, right? The fact that basically the benchmark is wrong. If you adopt a mean reversion trading strategy, you have to win on the reversion to make up on losing on the divergence, right? Like the impermanent loss concept says, oh, it's okay if you just break even on the reconvergence, right? Missing the fact that basically that's not enough. If you're losing on the divergence, you have to make up for it. Yeah. So that's really the difference between our concept and impermanent loss. Yeah.
And what like your thoughts? Like I like this concept, but something that I'm not sure about is because it's kind of a reference point, right? Like what is the benchmark? And some people can argue that this strategy is not really feasible for a regular trader, or like, you know, if I want to use your strategy as my benchmark, is not really an alternative that I can in reality do. What the only thing that I in reality can do is just all the assets. So that's why I can think about the impermanent loss as a good benchmark, while the other is very desired benchmark, but maybe not feasible so much to use.
I think how I would respond to that is, number one, like the big guys do this, like Jump and others, like basically do delta hedge their AMM positions. So then the big guys do. And then the other answer I'd give is like retail doesn't hedge their option positions either. So when you buy GameStop calls, you're not delta hedging it. Nonetheless, it is conceptually useful to think of an option as a bundle of two things. It's a bundle of delta exposure, which is just that stock price goes up and the auction gains money, and gamma exposure. And what we're doing here is conceptually the same thing, which is that sort of, and hopefully this will be clearer towards the end, we can think of an AMM as a bundle of basically slippage loss plus long exposure to the asset. And so the thing is, conceptually, you separately want to think about, do I want the long exposure or do I want the slippage loss? And so that's kind of like, for the retail guy, it's still a useful conceptual decomposition. And there are things the retail guy can do that takes this decomposition into account, even if they don't delta hedge. Like, for example, what could they do? They could ask themselves, should I LP for an AMM or should I instead just buy Ethereum? That is available to anyone. In doing that choice, the retail guy wants to think about loss versus rebalancing. Yeah. So that's a picture that shows the qualitative result. How do I get the quantitative result? Well, it turns out I can actually geometrically, hand-wavily prove the result using this picture. When prices P minus DP, the AMM buys quantity DX, right? And then the price that the AMM offers, it turns out, is basically the difference between the slope of this secant line. And then it turns out through some slightly ugly math that the slope of a secant line when you go from the P tangent to the P minus DP tangent is actually exactly the average of these two. So the AMM price is P minus 1/2 DP, right? Why is that useful? Because like, how much does the arbitrager make? The arbitrager is able to buy from the AMM at DX, amount DX, at the price P minus 1/2 DP, which is the slope of this line, right? And then the AMM sells at the price DX times P minus DP, which is this line, right? So what I'm trying to do is get the height of this vertical bar. And what I realize is the height of this vertical bar is DX times P minus DP over 2 minus DX times P minus DP, right? When I do that, what I realize is that this vertical bar is equal to DX DP over 2. DX DP over 2 can be written as dx dp times dp squared over 2. And then when I do that, what I realize is my dx dp, how much did the AMM trade when prices moved a given amount? That's just marginal liquidity, right? And then dp squared over 2, when you have a geometric Brownian motion at any instant over time, is sigma squared p squared over 2 times dt. And then so this is the geometric proof of the formula I have here. At any point in time, I'm losing this infinitesimal vertical bar, which through these like geometric calculus, we see boils down to sigma squared p squared over 2 times marginal liquidity. So if you like picture proofs, there's your picture proof. Is this idea parallel to opportunity cost? There's a sense in which it's parallel to opportunity cost, in the sense that basically, yeah, the rebalancing strategy measures your opportunity cost. If you did the same trade, but you did it on Binance, how much money would you make or lose, right? So I want to mention one thing, which is like if you're in the microstructure literature, you might ask the following, right? This is informed trading. This is a standard end thing where basically somebody knows the future and then trades against you. This is not true. So what we're emphasizing here, look at this formula. We have no informed trading here. We have volatility in this formula, right? There is a key difference between volatility and informed trading in our concept, right? Volatility is prices moving around, right? AMMs in this context lose money from volatility. They lose money because they cannot update quotes in response to price movements. So whenever prices move around, they suffer mechanical losses. It is very important that the losses here come from volatility. Why? Because informed trading is very hard to quantify. Volatility is very easy to quantify. If our theory says that AMMs lose because of volatility, we can go in the data, measure how much prices move around, and then measure how much AMMs lose. The fact that this is not an informed trader model, it's a volatility model, is why we can make it quantitative. The informed trader model's quantifications in the literature are much worse than the volatility quantifications like option pricing, because volatility is a measurable object and informed trading is not. So I emphasize that basically in our model, two separate concepts of the losses, it's important that volatility is the one we're talking about. So then you might ask the question, aren't you missing a term? If you're market making on an AMM, you should lose money both from volatility and also from informed trading. There should be the mechanical rip-off arbitrage. There should also be a new Gloston-Milgram term from informed traders also ripping you off. So this is a bit subtle, but it turns out that if you market make in this way, our trading strategy, where you long the LP and you short the rebalancing strategy, you don't suffer from informed traders. So this is like magic. Why do we not have informed trader risk here? The reason is because delta hedging eliminates directional risk. Suppose somebody knows about the long-term future of Ethereum prices, and then they try to buy from you because they know prices are going to go up, right? They're going to buy from you on the AMM. What you're going to do is you're just going to take that and sort of like adjust your position on Binance, right? And so because at any point in time after the rebalance, you are delta neutral. The market maker who basically arbs the like makes markets by long LP, short the rebalancing strategy, is not exposed to directional risk. The only case where the market maker loses money in this strategy is if I go and buy from the LP goes and tries to hedge and suddenly realizes in the process of hedging, oh shoot, the price moved and my hedge doesn't work. This market maker who longs an LP position and then rebalances basically is only exposed to basically slippage risk. They're actually not exposed to directional ETH risk. So that's a sense in which there are two concepts which in our minds sometimes get confused in this literature. Are losses of AMMs arising from basically informed traders or volatility? And then some papers seem to sort of like, it seems not completely clear like which this is coming from. What we want to emphasize is the design of AMMs leads to volatility-related losses. And sort of conceptually, we can think of LPing as only exposed to volatility-related losses, not informed trading losses in our context. Okay, so after that, I'm going to jump in. If you didn't like the picture, I have a nicer proof, which is, I think, less intuitive, but mathematically cleaner. What is a nicer proof? The value function is the solution to the following minimization problem. It is a function of P. At any P, I can figure out what you're holding and I can value it. It turns out that you can do some nice envelope theorem tricks. The derivative of the value function at any point is equal to X star of P, the demand. The second derivative of the expenditure function is equal to the demand slope. I think the Hicksian demand slope. And then so this proof just goes through the envelope theorem, right? So just differentiate. Then you have an actually simpler one-line proof of where loss versus rebalancing comes from. Take the value function and then just like differentiate the value function using Ito's lemma, right? And then over an instant of time, the value function gains V prime P times dP plus an Ito's lemma term, which is half times the second derivative, the curvature of the value function times the price movement, right? What do you get? You get X star dP plus half X prime sigma square P square dt, right? And so this is exactly loss versus rebalancing. Then you notice if you look at the rebalancing strategy, basically, dr is just equal to X star dP, And then if you subtract the rebalancing strategy and then the DV, what you get is that sort of loss versus rebalancing is negative of half marginal liquidity volatility. So this proof is kind of fancier, stochastic calculus and all. What's the intuition here? The intuition here, if you want an intuition, is that the expenditure function is a concave function, right? And the more aggressively you trade, the more concave the expenditure function is, right? So an AMM curve that looks like this has a very concave value function. An AMM curve that looks like this has a less concave value function, right? And then because the expenditure function is convex, you can think of loss versus rebalancing as just a downward drift of the convex function when you apply a convex function to a Brownian motion. And then so this is, if you like numbers more than pictures, mathematical proof of where loss versus rebalancing comes from. It comes from the concavity of the consumer expenditure function. Okay, and then so basically what we get ultimately is, let's go back a step, right? So what we did was that we said that the value function can be written as the sum of two terms. And AMM makes money from the start point because of the fact that it's exposed to market risk, which a rebalancing strategy is also exposed to, right? And then it loses loss versus rebalancing. Recall that the profit and loss of an LP is equal to accumulated fees plus the change in pool value. Now we figured out how to rewrite change in pool value, decomposing that into a market risk term, and then basically lever loss versus rebalancing. And then so we get a three-term decomposition. LP profits and loss is equal to market risk plus fees minus slippage cost loss versus rebalance. So as I said, three terms. The first term is basically, I am making money. This is exactly the rebalancing strategy, profit and loss. Stare at this. This is an envelope formula, right? If you hold X star P at time T and prices move by DP, you're making in that instant X star PDP, right? And then if you integrate this over time, you're getting this term. This is what you would get from the delta hedge strategy, right? This is like not due to anything special about the AMM. You can get exactly this return by doing a simple trading strategy that doesn't collect fees and has nothing to do with the AMM. Like delta hedging an option, this linear term we think of as like sort of, you can hedge it away. It's not fundamental to AMM. So as I mentioned, you hold Ethereum, you're exposed to market risk. The other thing to mention is that under risk neutral measure, it doesn't systematically make or lose money. This is another way to say once you hedge it, you eliminate the return, right? So there's nothing magic about this. This is just like long ETH exposure, and you get the same return no matter how long ETH exposure. Then you get this magic term, which is loss versus rebalancing, which is basically this slippage from trading at off-market prices. This is always positive. You never win with this. Your value function is concave, you're always losing money over time. And then you always get fees over time, right? So then the decision of basically whether to LP ends up boiling down to, do I think I'm collecting enough in fees to compensate for the fact that I'm suffering slippage costs? Because if not, then I can just like do the rebalancing strategy instead, and there's no reason to incur the bundle of these two terms. As I mentioned, basically, the nice thing is that you can do this. Like conceptually, you can do this. A bunch of market makers we talked to are doing this, which is that sort of you can hedge out the term and then isolate fees versus lever. Okay, I think I am supposed to end in 4 minutes. Is that right? Yeah, okay. Our formulas are quite easy to actually apply. So if you wanted to ask the question, how big is lever in practice, right? We can actually do this. And then so it turns out you get an extremely simple formula for the constant product market maker. We have formulas for other invariants also, but the constant product market maker has that the instantaneous loss as a fraction of the pool value is sigma squared over 8. So it turns out that sort of weighted geometric mean bonding functions have this nice property that the lever per dollar of pool reserves is independent of the price and the size of the pool, right? And then so we can then plug in. If sigma is 5%, then you lose 3 bps daily. So this is how we did the formula at the start. Now we're going to bring this more precisely to data. So as I mentioned, we kind of want to like show that this is a quantitative as well as qualitative model, right? So then what we're going to do is we're going to say that delta hedged LP PNL, right, should be equal to fees minus lever. And lever is a predicted object in our data. Now we're going to try and do two things. We're going to try and ask the questions, basically, is our formula accurate? And then after asking that question, we're going to ask, like, is it actually a good deal to LP? How can we test our model in the data? The reason we can test our model is when you write it this way, right? This you can measure in the data very simply. You can just say, if I put $1 into Uniswap LPing today, I took it out like a month later, how many dollars do I have? This is a rebalancing strategy. And you can just ask the following. If I put dollars into Binance to track my Uniswap Ethereum position and take them out, how much do I get? So the return of a delta hedged LP position is model free. I can measure this, and it doesn't depend on the model of the world that I have. It doesn't depend on our formulas being right? So I can measure this on the one hand. On the other hand, basically, we can measure fees, which I can also measure in a model free way. Then we use our theory, right? Then we use that sort of loss versus rebalancing. Slippage loss should be equal to sigma squared times p squared times x prime. And so this is a component that uses our model. That's the sense in which we can write this in a way that says, here's the profit from a certain trading strategy that I can measure empirically. Here's what our model predicts the profit should be. Do these things actually equal each other in the data? Oh, shoot. And then what we find is that when we do this, so let me first show you what happens when you hedge. This is the return. This is the value. This is the realized volatility of Ethereum, right? So Ethereum is very volatile. This is the returns from LPing on Uniswap, right? And so basically, if you LP on Uniswap, the value of your LP position is hilariously volatile. You're at 0, then you lose a ton of money, then you gain a lot of money, then you lose a lot of money. But the insight is like, this is because ETH is very volatile, right? And if you hedge this, you would think that the return of the hedge position should be a lot more attractive than the return of the LP position if most of the volatility is Ethereum, right? So let's do the following. Let's literally do the rebalancing strategy, sell as much ETH on Binance as I hold in the LP position, and see how volatile this looks. That's what happens. I kill like all of the volatility. I have a beautiful smooth line because all of the volatility on ETH LPing results from ETH volatility. And so this is the sense in which impermanent loss is a kind of muddy concept that says, like, this is your loss. And what we're saying is, this is the risk of long ETH. It's not a real risk because you can hedge it out. Once you hedge it out, this is the fees minus lever return. So zooming in on this, right, hedged P&L is the red line. So we've improved this somewhat, but basically hedged P&L is the red line, and then our prediction from the model is the green line. So we've gotten results that are a bit better, but it basically shows to us that our model pretty much works fairly well. So the difference, the black line, between hedged P&L and sort of our theory prediction is stationary and fairly small. And so our model does pretty well at actually predicting if you actually did the long LP short rebalancing strategy position in practice, how much would you make? Then we can just calculate how much this makes, right? And basically hedged P&L has a Sharpe ratio, which is like fairly attractive at roughly 4. So it makes a moderate amount of money, and it makes it with a pretty good Sharpe ratio. There's not much risk because once you hedge the ETH risk, there's not that much risk in fees minus lever, basically. So I will briefly talk about some implications and then conclude. Going back to the qualitative point, right? I mentioned basically that there is a design flaw in AMM. So if you know the Buddhist Crampton Shin paper, there's a design flaw in fast exchanges because basically when an exchange is fast, a market maker can't update quotes fast enough to get sniped. The AMM flaw is in a sense even worse. The AMM by design cannot ever update prices unless it gets sniped. It only ever learns prices through getting sniped. And that's what makes it so simple that it's not active. But it's also a design flaw in the sense that it leaks money due to the fact that it's not active. A big contribution we want to make in this paper is just like shining a bright light on the fact that the source of losses in AMM is a slippage loss from the fact that it can't update prices. And so here we mentioned basically ideas where sort of you could fix that in principle. You could in principle design an AMM that does update prices and it patches that slippage loss. Why would that be attractive? Because it wouldn't have to quote as high price impact in order to make the same amount of trades. It wouldn't have to charge as high fees. So you could pass these benefits on to the traders if you could patch this hole. And so it turns out a bunch of groups are now working on ideas to basically patch this hole and do things this way. Get this for reasons of time. What we wanted to do is put together this Black-Scholes formula for AMMs. Qualitatively, What are the sources of LP returns? It's a slippage loss times fees. Does the money you make from trading fees, is that large enough to make up for the losses you incur from slippage? Quantitatively, we want to do option pricing for AMMs. We want a simple formula that you can actually take to data, measure how much these things actually pay you. And we think we basically have formulas that, if we looked at data, actually give you correct predictions about how much you actually make. Okay, so I will stop there. Sorry for going a bit over time. Thanks.